For years, the American housing market looked unstoppable. Prices kept rising. Buyers kept bidding. Homes disappeared from the market in days. It felt like a machine that could never slow down. But markets rarely collapse in a single moment. They whisper first. They leave clues in quiet places most people ignore. And today, those clues are everywhere. The question is simple. Are we watching the early warning signs of something much bigger? Or are these just temporary cracks in an otherwise strong market? To understand what's happening now, we need to step back. Because the story of housing booms and housing crashes did not start in 2026. It started decades ago. And the pattern has repeated more times than most people realize. In the early 2000s, the housing market experienced one of the most dramatic expansions in modern history. Credit was easy. Mortgage approvals were fast. And banks were eager to lend. Millions of Americans believed home prices could only move in one direction. Up. Developers built neighborhoods at record speed. Investors bought multiple homes. Speculators entered the market hoping to flip properties for quick profits. For a while, it worked. Prices soared across cities like Phoenix, Las Vegas, Miami, and parts of California. But underneath that rapid growth, the foundation was becoming dangerously unstable. Too many loans were being issued to borrowers who could barely afford them. Adjustable-rate mortgages allowed buyers to qualify for homes far beyond their financial limits. And Wall Street turned those risky loans into complex financial products sold around the world. The result? A housing bubble. And when that bubble burst in 2008, the consequences were devastating. Home prices collapsed. Banks failed. Millions of families lost their homes. The global economy entered the worst recession since the Great Depression. It was a painful lesson, one that policymakers promised would never be repeated. Stronger regulations were introduced. Lending standards tightened. Banks were forced to hold more capital. For a time, it seemed the housing market had learned from its mistakes. Then something unexpected happened. A new cycle began. After the financial crisis, interest rates fell to historic lows. The Federal Reserve kept borrowing costs extremely cheap to stimulate the economy. Mortgages became more affordable than they had been in decades. Slowly, the housing market began to recover. At first, the rebound was cautious. Investors purchased distressed homes. Construction restarted. Prices climbed gradually. But the real acceleration came years later. During the pandemic. In 2020, the world changed almost overnight. Remote work became normal. Millions of people suddenly reconsidered where they wanted to live. Urban apartments lost their appeal. Suburban homes with extra space became highly desirable. At the same time, mortgage rates dropped to levels few economists had ever predicted. Some borrowers locked in rates below 3%. That single number changed everything. Buyers rushed into the market. Competition intensified. Homes started receiving multiple offers within hours. Prices surged faster than they had in decades. Across the country, bidding wars became the norm. In cities like Austin, Boise, Phoenix, and Tampa, home prices climbed at breathtaking speed. Investors also entered the market aggressively. Large institutional buyers began purchasing entire neighborhoods. Short-term rental platforms turned ordinary homes into profitable vacation properties. Supply, however, could not keep up. Construction had slowed for years after the 2008 crash. Builders faced labor shortages. Material costs soared. The result was a severe housing shortage. Demand exploded. Supply lagged behind. And prices skyrocketed. For many homeowners, it felt like winning the lottery. Their properties gained tens, sometimes hundreds, of thousands of dollars in value within just a few years. But every rapid boom raises an uncomfortable question. What happens when the conditions that fueled that boom start to change? By 2022, those conditions began shifting dramatically. Inflation surged across the global economy. The Federal Reserve responded with one of the fastest interest rate hiking cycles in modern history. Mortgage rates doubled, then nearly tripled. The impact was immediate. A buyer who could afford a $500,000 home at a 3% mortgage rate suddenly found that same payment could only support a $350,000 purchase. In other words, affordability collapsed. Almost overnight. Yet something strange happened. Home prices didn't immediately fall. Instead, the market entered an unusual phase. Buyers stepped back, but sellers refused to lower prices. Why? Because millions of homeowners were locked into ultra-low mortgage rates. Selling their home meant giving up a 3% loan and replacing it with a 7% one. Financially, it made little sense. So they stayed put. Economists began calling it the lock-in effect. Inventory stayed historically low, and the market froze. Transactions slowed to levels not seen in decades. But prices remained surprisingly resilient. At least for a while. Now fast forward to today. Something is beginning to change again. Subtle shifts are appearing across multiple regions. Homes are sitting longer on the market. Price cuts are becoming more common. And in certain cities, demand has quietly disappeared. These aren't dramatic collapses. Not yet. But experienced analysts know something important about market cycles. Major downturns rarely start with a sudden crash. They start with small signals. Signals most people dismiss. Signals that slowly grow louder over time. And right now, those signals are becoming harder to ignore. In parts of the country that experienced the fastest pandemic-era growth, the slowdown is already visible. Cities that once saw homes sell in days are now seeing listings sit for weeks. Some properties are returning to the market after failed deals. Others are undergoing multiple price reductions. The frenzy is fading. And when a market built on urgency begins to slow, psychology shifts quickly. Buyers who once feared missing out start asking different questions. Should they wait? Will prices fall? Is now really the right time to buy? These doubts can change everything. Because housing markets are not driven only by economics. They are driven by human behavior. Confidence fuels booms. Uncertainty fuels declines. And right now, uncertainty is spreading. But this is only the beginning of the story. Because the most important warning signs are not always visible on the surface. Some are hidden in data. Some are buried in local markets. And others are emerging from forces that could reshape housing demand in the years ahead. So what exactly are these warning signs? And why are more analysts starting to pay attention? To answer that, we need to look deeper. Much deeper. Because the signals now appearing across the housing market may reveal something far more significant than a simple slowdown. They may reveal the early stages of a major shift. One that could redefine the housing market in the years ahead. And the evidence is only beginning to surface. At first, the shift was almost invisible. The headlines didn't notice it. Most homeowners didn't notice it. Even many real estate agents dismissed it as a temporary pause. But markets often change quietly before anyone realizes what's happening. And the first real warning sign usually appears in one place: demand. Because housing markets depend on a simple balance. Buyers on one side, homes on the other. When that balance breaks, everything begins to move differently. And right now, across parts of the United States, that balance is beginning to shift. During the pandemic boom, demand felt endless. Every new listing attracted attention. Open houses filled with buyers. Offers came quickly, sometimes within hours. In many neighborhoods, sellers didn't even need to prepare their homes carefully. Properties sold regardless. Buyers waived inspections. They waived contingencies. Some even offered tens of thousands above asking price. It wasn't just competition. It was urgency. A belief that if buyers didn't act immediately, prices would move even higher. But urgency is fragile. It survives only as long as confidence remains strong. And confidence in housing is deeply tied to one powerful force: affordability. When mortgage rates began rising sharply, the financial math changed. Not gradually, suddenly. A difference of just a few percentage points in mortgage rates can transform a buyer's monthly payment. A home that once required a $2,000 monthly payment might suddenly require $3,000. For many households, that difference is enormous. It pushes homeownership out of reach. And that's exactly what began happening. Buyers who had been searching aggressively only months earlier started stepping back. Some paused their plans entirely. Others lowered their price ranges dramatically. And many simply decided to wait. Waiting may seem harmless, but when thousands of buyers make that same decision at the same time, demand begins to shrink. Slowly at first, then faster. Real estate agents began noticing subtle changes. Open houses that once attracted dozens of visitors now saw only a handful. Online listing views began declining. Homes that would have received multiple offers now received only one. Sometimes none at all. Sellers responded the only way they could: price reductions. At first, these cuts were small. A few $1,000s. Just enough to bring buyers back. But in some markets, the cuts kept coming. Because when demand weakens, pricing power shifts. And sellers begin facing a reality that hadn't existed for years. Negotiation. Another signal began appearing across the housing market. Listings were staying active longer. During the peak of the boom, the average home sold incredibly quickly. In many cities, listings lasted less than a week. Some lasted only days. But as buyer demand cooled, the clock started ticking again. 10 days, 2 weeks, a month, then longer. The difference may not sound dramatic, but in real estate, time carries meaning. The longer a property sits unsold, the more buyers begin to wonder: is the price too high? Is something wrong with the property? Will the seller lower the price soon? These questions weaken momentum. And momentum had been the fuel behind the entire housing boom. Another group of buyers also began disappearing. Investors. During the pandemic surge, investors became one of the most powerful forces in housing. Large companies purchased thousands of homes. Small investors entered the market hoping to flip properties or rent them out. Short-term rental platforms made vacation homes profitable in cities that had never experienced that type of demand before. But investors are extremely sensitive to numbers. When borrowing costs rise and home prices remain high, the math stops working. Rental yields shrink. Profit margins disappear. And when that happens, investors do something simple. They step away. Data in several regions has already shown this trend emerging. Investor purchases are declining. And when investors leave a market, one of the strongest pillars of demand weakens. But perhaps the most powerful force affecting demand is something less visible. Psychology. Housing markets are emotional. When prices are rising quickly, buyers fear missing out. That fear drives them to act faster, sometimes irrationally. But when momentum slows, fear begins to reverse. Instead of fearing higher prices, buyers start fearing lower ones. That shift is subtle but extremely powerful. Because once buyers believe prices may fall, patience becomes attractive. Waiting suddenly feels like a strategy. And if enough buyers adopt that strategy, demand can shrink very quickly. Yet the most interesting part of the current housing market is not simply the drop in demand. It's the strange imbalance that has followed. Even as buyers pull back, many sellers are still reluctant to lower prices significantly. Why? Because of the same lock-in effect created by ultra-low mortgage rates. Millions of homeowners are sitting on loans far below current market rates. Selling their homes would mean replacing a 3% mortgage with one closer to 7%. That decision could double their monthly payment. For many households, it simply isn't worth it. So instead of selling, they wait. They delay moving. They postpone listing their homes. This behavior has kept inventory surprisingly low. And low inventory has prevented prices from falling rapidly. But this balance is delicate. Because if inventory begins rising while demand continues weakening, the entire equation changes. Some early signs of that shift are already appearing. In certain cities, new listings are increasing. Builders are completing homes that were started during the boom. And some homeowners, facing life changes like job relocations or financial pressure, are choosing to sell despite the higher rates. Each new listing adds supply. And when supply grows while demand shrinks, the market begins adjusting. Not always quickly, but steadily. History has shown this pattern many times before. Housing downturns rarely begin with dramatic headlines. They begin with quiet changes in buyer behavior. A few more price cuts. A few more unsold homes. A few fewer buyers showing up at open houses. At first, these signs seem small, almost insignificant. But over time, they accumulate. And when enough of them appear together, they form something unmistakable. A trend. Right now, the housing market may be entering that phase. A moment when demand is no longer guaranteed. A moment when sellers must begin adjusting expectations. And a moment when buyers are gaining something they haven't had in years. Time. Time to compare homes. Time to negotiate. Time to wait for better deals. For some buyers, this shift feels like long-awaited relief. But for others, especially those who purchased near the peak, it raises uncomfortable questions. What happens if prices begin falling? How far could they drop? And which cities are most vulnerable? Because not every housing market behaves the same way. Some regions remain surprisingly strong, but others are already showing deeper cracks. And those cracks may reveal where the next phase of the housing cycle begins. In the next part of this story, we'll explore the places where the warning signs are becoming impossible to ignore. Cities where homes are sitting unsold, prices are quietly slipping, and the housing boom that once seemed unstoppable is beginning to lose momentum. Because if history has taught us anything about real estate cycles, it's that downturns rarely start everywhere at once. They start somewhere first, and the locations where those first cracks appear may tell us exactly where the market is heading next. Housing markets rarely move in perfect unison. Some cities surge ahead during a boom. Others follow more slowly. And when a downturn begins, the same pattern often appears in reverse. Certain regions weaken first. Small cracks form. Then those cracks begin spreading outward. To understand where the housing market might be heading next, analysts often focus on one simple question: where are the first cracks appearing? Because those early signals can reveal far more than national averages ever could. During the pandemic housing boom, several American cities experienced extraordinary growth. Home prices didn't just rise. They exploded. Places that had once been considered affordable suddenly became some of the fastest-growing housing markets in the country. Cities like Austin, Phoenix, Boise, Tampa, and parts of Florida saw dramatic increases in demand. The reasons were clear. Remote work allowed people to move away from expensive urban centers. Lower taxes attracted new residents. Warm climates and expanding job markets made these regions even more appealing. Millions of Americans relocated, and investors followed closely behind them. For a while, these cities looked unstoppable. Prices climbed month after month. Developers rushed to build new neighborhoods. Local economies thrived as construction accelerated. But rapid growth often creates vulnerability. Because when a market expands too quickly, it becomes highly sensitive to change. And when mortgage rates began rising, these once booming regions were among the first to feel the impact. In some of these markets, homes that once sold within days began sitting on the market. Weeks passed, then months. Price reductions started appearing more frequently. Not dramatic cuts at first, just subtle adjustments. But the pattern became harder to ignore. In certain neighborhoods, sellers who had expected bidding wars were now negotiating with the few buyers still actively searching. Builders also faced a new challenge. Many of the homes under construction during the boom were finally reaching completion. Yet the buyers who had once filled waiting lists were no longer as eager. Developers responded the only way they could. They offered incentives, closing cost assistance, mortgage rate buydowns, even direct price discounts. These incentives were rarely highlighted in headlines, but within the industry, they were seen as a clear signal. Demand was weakening. Another interesting pattern began appearing in migration trends. During the height of the pandemic boom, millions of Americans moved to smaller cities and suburban regions. But relocation patterns are rarely permanent. Some workers began returning to offices. Others realized remote work would not remain fully flexible forever. Gradually, migration flows began stabilizing. The explosive population growth that had fueled housing demand in certain regions slowed. And when population growth slows, housing demand often follows. This doesn't mean cities suddenly lose residents, but the pace of new buyers entering the market declines. And in markets built on rapid growth, that slowdown can have powerful effects. Certain parts of the Sun Belt are now being watched closely by housing analysts. These regions benefited enormously during the pandemic boom. but they may also be more exposed if demand weakens further. Why? Because many of these markets saw the largest price increases in the shortest amount of time. In some areas, home values doubled within just a few years. Rapid appreciation can create a fragile environment. If buyers believe prices have peaked, they become cautious. And once that caution spreads, the market's momentum begins to fade. Another factor quietly shaping these markets is insurance and climate risk. In several coastal states, insurance costs have risen sharply. Storm risks, flood zones, and extreme weather events have forced insurers to adjust pricing. For homeowners, these costs add to already rising mortgage payments. In some cases, they dramatically increase the true cost of owning a home. Buyers notice this, and when ownership becomes more expensive than expected, demand softens. It's another subtle pressure building beneath the surface of certain housing markets. Meanwhile, in some historically expensive regions, the story looks different. Cities in parts of the Northeast and Midwest did not experience the same explosive pandemic growth. Their price increases were more moderate. Ironically, this may now provide a degree of stability. Because when prices rise more gradually, they are less vulnerable to sudden corrections. These markets may still slow, but they may avoid the sharper volatility seen in cities where prices surged too quickly. Every housing cycle produces regional winners and losers. The challenge is identifying which areas fall into each category before the trend becomes obvious. Another warning sign analysts are watching closely is price reductions. In many markets, the share of listings with price cuts has been rising. Not dramatically, but steadily. A single price cut doesn't mean much. But when a large portion of listings begin adjusting their prices, it reflects something deeper. Sellers are reacting to weaker buyer demand. They are adjusting expectations. And once price reductions become common, they can influence the behavior of future sellers as well. New listings often study the competition carefully. If multiple nearby homes have already lowered their prices, sellers may list their property lower from the beginning. This process gradually resets the market. And once it begins, reversing it can take time. Yet even with these early cracks, it's important to recognize something crucial. The housing market today is not identical to the one that existed before the financial crisis of 2008. Lending standards are stronger. Most homeowners have significant equity. Mortgage borrowers today are generally more financially stable. This means that even if prices decline in certain markets, widespread foreclosures are far less likely. At least for now. But housing markets do not need a financial crisis to experience corrections. Sometimes all it takes is a change in supply, demand, and expectations. And those three forces are already shifting in several regions. The early cracks appearing in certain cities do not guarantee a nationwide housing crash. But they do reveal something important. The market is no longer moving in a single direction. For years, rising prices felt inevitable. Now uncertainty is returning. Buyers are hesitating. Sellers are adjusting. Investors are becoming more cautious. These are the early ingredients of a changing market cycle. And cycles, once they begin turning, can unfold slowly at first, then much faster than anyone expects. In the final part of this story, we'll explore the larger forces shaping what happens next. Interest rates, supply shortages, economic uncertainty, and the long-term factors that could determine whether the housing market simply cools or enters a far more significant shift. Because the warning signs we see today may only be the beginning. And understanding what comes next could determine how the entire housing market evolves in the years ahead. Every housing cycle eventually reaches a turning point. But that turning point rarely arrives because of a single event. Instead, it emerges from a combination of forces: economic shifts, policy decisions, changes in human behavior, all slowly pushing the market in a new direction. And right now, several powerful forces are beginning to shape what the next phase of the housing market may look like. The warning signs we've explored so far, weakening demand, rising price cuts, and regional cracks, are only part of the story. Because the future of the housing market will ultimately depend on something far larger: the economic environment surrounding it. At the center of that environment sits one crucial factor: interest rates. For more than a decade, the housing market benefited from historically low borrowing costs. Cheap money fueled demand. It allowed buyers to afford larger homes. It pushed investors into real estate. And it made rising prices feel manageable. But when interest rates rise sharply, the entire equation changes. Mortgage payments increase. Affordability declines. And fewer buyers can qualify for loans. This is exactly the dynamic that has been unfolding over the past few years. The rapid increase in mortgage rates has already removed millions of potential buyers from the market. And unless borrowing costs fall significantly, that pressure will continue shaping housing demand. Yet interest rates are not the only force influencing the market. Supply also plays a critical role. For years, the United States has faced a housing shortage. Home construction slowed dramatically after the 2008 financial crisis. Many builders left the industry. Development projects stalled, and new housing supply struggled to keep up with population growth. This shortage helped support home prices during the recent boom. Even when demand weakened slightly, the limited number of available homes prevented prices from falling quickly. But supply conditions are slowly evolving. Builders who began projects during the pandemic surge are now completing those homes. New construction inventory is rising in certain regions. And although the overall housing shortage still exists, localized supply increases can change market dynamics quickly. In areas where new homes flood the market while buyer demand weakens, price competition can intensify. Another force shaping the future of housing is demographics. Large generational groups are moving through the housing market at the same time. Millennials, now the largest generation in the United States, are entering their prime home-buying years. Many still hope to purchase their first home, but high prices and elevated mortgage rates have made that goal more difficult. At the same time, older homeowners are holding onto their properties longer than previous generations. Some are choosing to age in place rather than downsize. Others are financially comfortable remaining where they are. This behavior reduces the number of homes entering the market, and it contributes to the persistent supply constraints we see today. The interaction between these two groups, millennials trying to enter the market and older homeowners choosing not to leave, will heavily influence housing supply in the coming decade. Economic uncertainty also plays a major role. Housing markets thrive when employment is strong and incomes are rising. When people feel financially secure, they are more willing to make long-term commitments like buying a home. But when economic uncertainty increases, buyers become cautious. Job market concerns, inflation pressures, rising living costs. All of these factors affect the confidence required to make a major financial decision. Even small shifts in economic outlook can ripple through the housing market. And when uncertainty grows, patience often replaces urgency. Government policy is another powerful variable. Housing markets are deeply connected to policy decisions. Mortgage regulations, interest rate policies, tax incentives, zoning laws, all shape how housing markets function. Policymakers are constantly balancing competing priorities. They want housing to remain accessible, but they also want financial stability. Sometimes those goals align. Other times they conflict. Future policy decisions, whether related to interest rates, housing development, or financial regulation, could dramatically influence how the housing market evolves. Yet perhaps the most powerful force shaping housing markets is something less tangible. Expectations. What people believe will happen next. When buyers expect prices to rise, they rush into the market. When they expect prices to fall, they hesitate. That psychological shift can transform market behavior faster than any economic statistic. Right now, expectations appear to be changing. For years, rising home prices felt inevitable. Home ownership was viewed as a guaranteed investment. But the recent slowdown has introduced a new possibility: that prices may not always move upward. This realization does not automatically trigger a crash, but it does change how buyers and sellers approach the market. And when expectations shift, the entire rhythm of housing activity can change with them. So what does all of this mean? Are we approaching a major housing crash, or simply experiencing a necessary cooling after years of extraordinary growth? The honest answer is that housing markets rarely follow simple predictions. Some regions may experience price declines. Others may stabilize. And some may continue growing, though at a slower pace. Real estate is intensely local. What happens in one city may look completely different in another. But even with those regional differences, the broader trend appears clear. The era of effortless housing gains is fading. The market is entering a more complex phase, one where affordability matters again, where buyers negotiate, where sellers adjust expectations, and where market momentum is no longer guaranteed. The warning signs we see today do not guarantee a collapse, but they do signal something important. The housing market is changing. The explosive growth of the pandemic years is behind us. In its place is a market searching for balance. And that search may take time, because housing markets move slowly. They build momentum gradually. And when they shift direction, the process often unfolds over years rather than months. In the end, the story of the housing market is not just about prices. It's about people, families deciding where to live, workers relocating for opportunity, investors evaluating risk, builders responding to demand, and policymakers attempting to guide the system without breaking it. All of these forces interact to shape the housing market's path, sometimes smoothly, sometimes unpredictably, but always with consequences that reach far beyond real estate itself. Because housing is not just another asset class. It is the foundation of communities, the largest financial decision many people will ever make, and a central pillar of the economy. So as we look at the warning signs appearing across the housing market today, one thing becomes clear. We are witnessing a transition, not necessarily a collapse, but a shift. A moment when the forces that drove one cycle are giving way to the forces that will define the next. And the question now is not whether change is coming. The signs suggest it already has. The real question is how far that change will go, and which parts of the market will feel it first. The housing boom of the past decade created extraordinary gains for homeowners and investors. Low interest rates, strong demand, and limited supply pushed prices to historic levels. But the environment that fueled that growth is evolving. Mortgage rates have risen. Buyer demand is softening. Certain cities are showing early cracks. And economic uncertainty is reshaping expectations. These warning signs do not guarantee a housing crash, but they do reveal a market entering a new phase, one defined by caution, adjustment, and shifting power between buyers and sellers. The housing market is no longer unstoppable. And as history has shown time and again, the moments when warning signs are everywhere are often the moments that shape what comes next.